Hello class, my name is Samuel, and in this presentation, I will outline why the financial industry should not be solely blamed for economic meltdown of 2008. First and foremost, a healthy and vibrant economy requires a financial system that moves funds from people who save to people who have productive investment opportunities. As such, the financial system exists to promote economic efficiency. The financial system is complex in both structure and function, like most of us will know. It includes a myriad of institutions that include banks, insurance firms, mutual funds, stock and bond markets. Bottom line, all these institutions are regulated by the government. And this is important to note. Which brings me to the point that weak regulatory process largely contributed to 2008 economic meltdown. And this is why. In 1999, Gramm-Leach-Bliley Act became law. This act repealed portion of Glass-Steagall Act, paving way to a myriad of deregulations on financial institutions. Unscrupulous actors of financial institutions took advantage of the deregulated financial system, thus engaging in questionable lending practices. Just to put things into perspective, by deregulation, some investment institutions turned into commercial institutions. A prime example is Citigroup. Citigroup is an insurance company that performed the role of commercial banks during that period of time. To cut the long story short, I reference Annenberg Policy Center report, which sums up who is responsible for the 2008 financial meltdown. Top of the list is the Federal Reserve. The Federal Reserve System, during the period leading to 2008, had slashed interest rates following the deflation of the dot-com bubble. This led to cheap credit. Home buyers took advantage of this cheap, easily available credit to acquire and speculate in homes business. Second, Congress is to blame since it continued to support a mortgage tax deduction that gave consumers a tax incentive to purchase more expensive homes with a possible default risk. Third, the Clinton administration. The Clinton administration is to blame also by facilitating easy acquisition of homes through softening of credit and down payment requirements for working and middle class families. Fourth, mortgage brokers. Mortgage brokers offer less credit worth home buyers subprime adjustable rate loans with low initial payment, but very high interest rates. And at the end of it was a systematic default in repayment of the loans. Fifth, the Federal Reserve. The Federal Reserve encouraged the American public to obtain subprime mortgage, knowing very well it presented default risk. Sixth, the Bush administration. The Bush administration failed in its oversight role, which required of it to evaluate the potential risk presented by mortgage-backed securities market. And finally, the obscure accounting procedures, which allowed for off-balance sheet accounting. This made assets less worthy on paper than they were in actual sense, creating a loophole for fraud. Now, to minimize a similar repeat of the events of 2008, I believe the reforms presented by the Basel Committee on Banking Supervision should be enforced. The Basel Committee proposals included linking capital requirement for large internationally active banks more closely to actual risk of three types. Risk number one is market risk, number two, credit risk, and number three, operational risk. Second, strengthening supervisory process, particularly in assessing the quality of risk management in banking institutions. And finally, improving market discipline through increased disclosure of details about a bank's credit exposures. its amount of reserves and capital, the officials who control the banks, and the effectiveness of banks' internal rating system. In summary, the government should not sleep on the job. It should actively play its regulatory and oversight role and ensure proposals such as those of the Basel Accord are implemented. Thank you.